Between these two reference points, that being this candle's high and this candle's low, that one candle right here in that shaded area that's purple, there's going to be small inefficiencies in that range that's shaded in purple. The easiest way to simplify it is we don't need to know yet where those small little pockets are on the lower time frame because this is a weekly candlestick. Inside that range, somewhere along the line in that very week of data, there are gaps, inefficiencies. We don't need to know exactly where they are, but we can identify that range right here. As soon as this candle closes and we begin a new week, that gap that's shaded in purple, we know that there's a likelihood that the market will want to, at some future time, want to reprice to that. That is not balanced. All it means is that shaded area that's purple, it's buy side imbalance. So the market's shown an imbalance, meaning it wants to go up. It did go up. So what is it inefficient? It's inefficient in the sense that it hasn't had a sell side delivery. Sell side is when price is being offered downward. For that purple shaded area here, for that to be repriced to and offset the inefficiency of sell side, because it's buy side imbalance, it's imbalanced. It has to be balanced later on, and I'll tell you how it becomes balanced. But right now, what is it lacking? It's lacking sell side delivery. That means a candle must trade down in between the high and low of that purple range. So in my mind as an analyst, I'm looking at this and thinking, okay, well, we've seen a lot of back and forth price action all through here. Okay, so inside that darker shaded pink area, inside that rectangle, notice how there was a lot of back and forth, up and down price delivery. You see how it's created like a small little trading range in there? Where is there a break in all of that back and forth movement? It's in that shaded purple area here. So up and down, back and forth, all inside this pink area. Price has done a very good job of moving back and forth inside that pink shaded area, but it didn't do a very good job of efficiently offering sell side delivery in that little area right there. So what the algorithm does, it seeks those areas there because it's easily defined by arrays, old highs and lows that are separated across the spectrum of 3 24-hour periods, any separation between this time frame or any other time frame. So we know that there is a strong tendency for the market to want to come back and reprice into these areas. So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked which time frame do I spend the most time on, it's the weekly chart. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. What I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside. Or consequent encroachment, which is the midpoint of this candle's tail. I would either look for that midpoint of that candle's tail, or I would use the low of that wick. If there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? Because we already hit our targets that I covered in the previous weeks. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. It's only going to go up for one of two reasons. Price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops, or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up. And if it's going up, what liquidity is that? Buy side liquidity, buy stops. When price is moving back and forth in a defined range, price has moved rather efficiently inside that pink area, up and down. Where are the inefficiencies and where are the stops? The first thing I'm looking for is inefficiencies, because that's the array that the algorithm reaches for first. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there's no fair value gap formation whatsoever in the candle I'm highlighting right now. So what is actually happening there? The price has gone up and down, up and down. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high and the close of this candle here. Think about what I'm showing you here and how that relates to this area right over here. That same idea, we can apply it to over here. Same thing here. Price opens up, trades higher, back and forth delivery, all the way up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Right here. So there's a gap there. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here. This traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model 2292. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, but they are really good ones between the 7 o'clock and 9 o'clock New York Open Kill Zone and between 3 o'clock and 5 o'clock London Open Kill Zone. They're there every day. I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. How can we determine where that likely higher low is going to form, or where would it likely reach to, starting on these higher time frame weekly charts? And if we know that we can see prices likely to want to expand lower, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? Every weekly candlestick, high and low, is a factor as well. They're going to be used. Again, they don't just get used one time and they expire. I teach there's a 60-day look back, and the highest form of precision or highest form of accuracy in terms of my key levels, I define it within that 60-day range, and it's 60 market days, not 60 calendar days, obviously. So what I'm looking for is the highest high and the lowest low in the last 60 days. I'm looking for inefficiencies in the last 60 days, whether it be premium or discount. That means a fair value gap like that purple one here was. When I look at this range, this shaded area, it doesn't look like a fair value gap on the daily chart, whereas that is a fair value gap. You see that right there? Notice that that is not what you see inside of the shaded area here. That was the weekly inversion fair value gap. So the price delivery continuum is when you have these higher time frame inefficiencies, regardless of whatever time frame it is, when you drop down to a lower time frame, you cannot ignore or forget the impact that those higher time frame inefficiencies will have on the lower time frame. The lower time frames you can use for precision, like refining risk and making it much smaller so larger positions can be assumed.